Good morning, everyone. So, this is one of our first sessions in September. That is a webinar. I'm really excited to be here. Let me make some introductions and then we can kick off the session. We're honored here to welcome Markus Susilo, partner and head of tax at Baker Tilly, UAE, as our speaker for this important session. Markus also serves as the business leader, the international business leader representing the UAE within the global Baker Tilly network and driving cross-border client developments and collaborations. Markus has nearly 2 decades of experience as an international tax and corporate advisor. Markus has supported multinational groups, SMEs across the UAE, wider GCC, and Western Europe. His expertise lies in establishing, restructuring, and managing cross-border operations with a strong focus on tax, legal, and regulatory compliance. Over the years, he has been entrusted with board and company secretary roles in the UAE and Austria, a reflection of his long-standing position as a trusted compliance and tax partner. Markus founded the German and Austrian desk in the UAE, catering to the growing German-speaking business community here. He is also a recognized contributor to several regional tax committees. He is also a UAE tax agent and a trusted business advisor to the Austrian Embassy commercial section. On behalf of It's Her Way and our wider community of female entrepreneurs, we sincerely thank you, Markus, for taking the time to guide us today. Your commitment to sharing knowledge and empowering businesses with clarity on complex tax and compliance issues makes this session invaluable. Thank you so much, Markus. Over to you.
Thank you, Armin, for the introduction and the opening note, and thank you for all of you who have taken the time to let's say listen a bit on the corporate tax matters that I'm going to present in the coming, let's say, half an hour or 45 minutes. I think what we're going to touch upon today is, I would say, is a hot topic currently in the UAE, considering that most companies will have to file their tax return on the 30th of September this, let's say, 2025, which is the end of this month. And this is also applicable not only for, let's say, companies, but also if you have any branch offices, this is something that you need to look at, whether you need to register and submit for the tax return for the 2025. And of course, and for most companies as well, that this is going to be the first tax period for, let's say, for this type of filing in the UAE. Now, just 1 second. So this will be the topics that I will cover today in this webinar, and what I'm going to structure the content that I'm going to present to you is that it's going to be as much as possible less technical one, and two, it will be more based more on our experience so far dealing with some of the cases and some of the frequently or let's say frequent challenges that we have seen in the market, at least in the past 7 or 8 months. Now I'm going to touch upon a bit about the city registration. I understand that most companies have registered for city for corporate tax, but perhaps there are a couple of things that you still need to consider. So this is something that we're going to look at it. The second one is, of course, on the qualifying free zone person status. There is I mean, if you look at the businesses in the UAE, it is made out of, let's say, a bigger chunk of free zone companies and also mainland companies. So for those of you who are located in the free zone, perhaps this would be quite useful of what I'm going to discuss in that section. The third of all is about the control transaction. Control transaction, basically in the let's say market language, we're talking about so-called the transfer pricing matters. And then another thing that I'm also going to cover is a certain part of the law that might be, let's say, relevant when there is a double tax treaty or double tax avoidance agreement between the UAE and another country. And then later on, the tax group and the group relief, especially for those of you who have several companies in the UAE. And I'm going to discuss some of the, let's say, cases that we have or certain challenges that we have between the tax group, and then how it can be resolved with certain group relief that we have. And then the so-called irrevocable election. So why it is important in the what we call irrevocable election is that once you elect in your first tax period, you won't be able to change it in the upcoming tax period. So this was I'm going to cover very briefly. And the last one is, of course, about the governance and the potential penalties in case of incorrect or the late payment or late filing of the corporate tax itself. So let me start first with the registration. So here, what
Okay.
I'm going to discuss is not the let's say when you should register and how you should register, but more on the challenges that we have seen so far with the branches of foreign companies and the mainland branches of qualifying free-zone person. Now, what we have seen so far is that, or at least here we are here in the UAE, especially in Dubai, we do have a lot of international businesses or international companies who are active here, both in the both as a subsidiaries of a foreign company, of a branches of foreign companies. Now, in the UAE as well, as I mentioned earlier, we do have free zone, let's say, location and non-free zone location. Now, when it comes to free zone and non-free zone location, there are also, I mean, the two of them. If you are, if the free zone company become a qualifying free zone person, then basically it will have two different tax regime between the free zone entity, and if it has a branch in the mainland UAE, then it will have two different tax regime on its own. Now, what we have seen so far in the market is that when you are a branch of a foreign companies or a branch of a free zone person, uh, most people would either immediately register for corporate tax, or some people said, look, because we only have branches, we're not going to register for corporate tax. So this is something that we have seen so far, not only for, let's say, smaller entities, but also for larger corporate that have been, let's say, operating here. So this is something that I would like to share our experience and also certain knowledge here is that first of all, before you even decide to register for those branches for corporate tax, you need to assess whether those branches on its own are creating any permanent establishment or not in the UAE. Because if it has a permanent establishment in the UAE, or in case of a mainland branch of a qualifying foreign person creates permanent establishment within the mainland, let's say location, then only then you should register. Because there are also a couple of cases that we have seen that those branches do not have any permanent establishment within the country or within the mainland for qualifying foreign person. And for those type of branches, then actually you do not need to register. So this is one thing that you need to have a look in detail. That basically what I'm trying to say is that not all branches will have to be, or branch offices have to be registered for corporate tax in the UAE. Now, the second one is, of course, the concept of nexus. So nexus has been introduced for, let's say, what we call it non-resident juridical person, where they have a certain income here from real estate property or real estate property here, then they actually need to register, right? So this is something that you need to look at, especially where, I mean, if you have, let's say, if you have some properties here in the UAE, and this property is owned by any of your entity that is located outside the UAE, you might want to have a look whether we actually have nexus here and register for corporate tax, and at a later stage file for corporate tax return and pay whatever is due in terms of the tax liability. So that's the first part of the registration aspect. So I think let's move on to the next topic, which is qualifying free zone person status. A lot of companies have approached me and saying like, okay, can we be a qualifying free zone person or not? I just want to make it clear that the fact that you are or you are not qualifying person, this is a default position. So in the way that when we first do the analysis, we need to test whether you are a qualifying person or not as a company, right? And of course, there are a couple of conditions to be fulfilled for being a qualifying person. There are 6 or 7 conditions, and all of those conditions must be fulfilled. Now that also includes certain conditions that relates to, let's say, qualifying income that you are earning out of your free zone companies. So it's not that, again, I just want to repeat here, it's not that you are electing to be a qualifying free zone person. It is either you are a qualifying free zone person or not in the very beginning, right? However, in those 6 or 7 conditions that have been prescribed, there is one condition where they are saying, look, even if your default position is qualifying free zone person, you still have the chance to elect not to be a qualifying free zone person, right? There are certain reasoning for those, for some companies not to elect for being qualifying free zone person. So basically what I'm saying here is that even if after the analysis are you are in the default position of being a qualifying free zone person, you can still you can still do further, let's say, economic analysis, saying, look, is it beneficial or not for me to be qualifying free zone person? If it's not, you can elect it. But one needs to also take into consideration that once you're not a qualified free zone person, then basically for the subsequent 4 years, you won't be able to be to be a qualifying free zone person again. So basically, this is something that you need to take into consideration. This is usually applicable for, let's say, in our cases, what we have seen so far. This analysis is very crucial when you are just starting business here in the UAE, whether you are part of a larger corporate or you are, let's say, a smaller company. So this is something that you need to take into consideration. That's one. Two, last week we have had the amendment of the so-called of the certain definition of qualifying activities. Now, if you go to our LinkedIn account, I think we have posted the summary of those amendments. Now, these amendments are actually quite, let's say, is quite significant for certain businesses. So if you already filed your tax with a certain position, you might want to have a look at this amendments and see whether this is actually applicable or not for you, because it might lead either that you are correcting your return, or this is actually have no impact. So this depends on from business to business. And of course, when you're doing, let's say, disqualifying free zone person analysis, it is also very important to make sure that one of the conditions that I'm going to discuss in the upcoming slide is what we call it the transfer pricing. So as I mentioned earlier, so the document that you need to have sufficient evidence to make sure that any transactions be connected and related parties are at arm's length. Because if you miss just if there is a tax audit at the FTA, basically, or if you cannot prove to the FTA that this type of transaction at arm's length, you are risking of losing this status, which means that whatever was not tax, was exempt income, or was in the, let's say, in the 0% position in terms of the tax liability, it might be the case that you will be asked to pay the penalty plus all of this due tax. So this is what I would like to share about the qualifying free zone person status case. Armin, we can go to the next point, which is what we call a control transaction. So why I use the word control transaction here? I mean, why? Because what I meant by control transaction is basically transactions that within the group of companies that you have or that you own, you can actually control the transaction in terms of its condition, in terms of its pricing, right? And in our law, it is mentioned that these are transactions with related parties and connected person. Now, further, the law said, and as mentioned earlier, that those transactions will have to be priced at arm's length, right? What does that mean, arm's length? Arm's length is basically, in short, or in layman term, it will be at market value. But then, of course, the FTA has issued quite extensive UAE transfer pricing guidelines, and on top of the regulation that they have mentioned in the corporate tax law. And these guidelines has taken into consideration the OECD transfer pricing guidelines 2022. Now, what I'm trying to say here is that yes, from the layman perspective, that so this concept of arm's length is basically a market value, but how to determine that market value, you need to require quite an extensive transfer pricing studies. Because what happened is that, at least so far, we have seen with some of the companies, they're saying, look, you know what, if I'm selling, let's take an example of transaction between related parties for trading purposes, so selling goods from one entity to another entity. So some companies may say, look, you know what, if I'm selling the same goods from my company to a third party client with a certain price, then basically, as long as I'm using this price to sell the same goods to my related parties, that should be immediately at market value. Now, one needs to understand as well, it might be right, it might be challenged at a later stage, because the conditions of the related party that you have and the condition or the fact and circumstances of the third party clients that you have, it might be different. It might be the case that on the surface, as a layman, you see these two types of transaction are the same transaction, but in reality, once you do the transfer pricing studies, it is similar transaction, but not the same transaction. So this is where, if any of you would like to do further transfer pricing studies when it comes to what is actually the arm's length price of this, let's say, this trans-specific transaction, I do encourage you to go to the FTA website and go to their UAE transfer pricing guidelines documentation. This will help you to understand how our FTA going to look at the so-called transfer pricing studies and what are acceptable for them. So this is maybe something that I would like to share based on the challenges that I've seen so far in the market. Now, the next one is what we call it, the double taxation avoidance agreement. Earlier, in one of the earlier slides or 2 slides ago, I've mentioned the concept of permanent establishment. Now, the UAE Corporate Tax Law also has its definition of permanent establishment. So permanent establishment is basically, I would say, is a fictive tax presence of a non-resident juridical person in the UAE. Now, before I go further into permanent establishment, I would like to go back into the double taxation avoidance agreement. I mean, it is important because in our corporate tax law as well, it's also mentioned that if there is any other international agreement that has been signed between the UAE and other countries, and there is a certain provision in the corporate tax law that basically contradict from that agreement, that international agreement, will basically supersede the local law that we have, which is common practice globally. Which means that if you, I mean, again, going back to the UAE or has positioned itself as a global business hub. What does that mean? That means that a lot of international companies have their presence here, and there is a lot of transaction between the companies located in the UAE and other jurisdiction outside the UAE, even if it's within, let's say, if it's within one group as well. So when you are analyzing your tax liability and how it will impact you, especially when it comes to cross-border transaction or cross-border relationship. You need to also take into consideration the international agreement that the UAE has actually concluded and agreements that are in effect currently with the other countries, right? And now one of the major things that you need to look at is so-called this concept of permanent establishment. So it might be the case that the permanent establishment concept in the corporate tax law is different than the one that is being that is stated in the double taxation avoidance agreement that has been signed between the UAE and a specific country. Now, if that is the case, then you need to look at how the double tax treaty has been concluded and what the provisions is over there. Now, another part that is quite important is further to the permanent establishment is the concept of the residency. Now, yes, it is true in our corporate tax law that as soon as a company is established in the UAE, then automatically you need to register for city and become taxable person. However, this concept becomes more critical when you have a non-resident juridical person and you have a certain member of the management of that non-resident juridical person sitting in the UAE. So you need to then consider where is actually the place of effective management. In most cases, when you follow the or when the double taxation avoidance agreement follows the OECD model convention, the residency of a juridical person usually is where place of effective management is in place, which means that if the place of effective management is in the UAE, then in most cases of the treaty that follows the OECD model convention, the tax resident of the company immediately becomes the UAE, and therefore any income that is earned by that specific juridical person will then be taxed. A global income of that juridical person will then be subject to tax in the UAE. So this is something that one needs to take into consideration as well. Now, the last one that I would like to mention about this double taxation avoidance agreement is, of course, the treaty benefit. So once you decide on once you determine, sorry, not decide, but once you determine where your tax resident is, so you can have a look at what sort of treaty benefits that you can actually take into consideration whilst you're calculating your tax liability here within the UAE. So this is maybe something that one needs to consider when you are calculating your taxable income prior to filing your tax return. Now, the next one is that I would like to mention a bit about so-called the concept of tax group that we have here in the UAE, or the group relief. Now, for companies or group of companies who have their tax period ending 31st of December 2024, and if you manage to apply for, let's say, as a tax group and being approved by the tax authority, our FTA, that is good. And I hope before you do this kind of grouping, you would have done the cost benefit analysis of being in the tax group. Of course, one of the major advantages of being in a tax group is that you will reduce a certain level of tax administration that is required from yourself. Especially, and also there is a certain advantage as well when you calculate your tax liability, when certain group members are in the profit-making position, the other one is in the loss-making position. So you might be able to offset. It is let's say another benefit that you can enjoy for being in one tax group. However, if you are a group of companies, but you are not, you have decided not to form a tax group, then and you still want to transfer the loss of certain related parties to another related parties, then the UAE corporate tax law has given another relief. That's what we call it, the group relief. So you might, if so, basically what I'm trying to say here is that if you have several entities in the UAEs that are related uh, related with each other, you might want to have a look, and they are not in a tax group. You might want to look at another possible relief, which is basically a possibility to transfer the loss from one members of we call it qualifying group to another member of the qualifying group. So you do not need to be in the tax group to do that, but you need to fulfill the condition to be in a qualifying group, and then you will be able to utilize certain portion of the loss of one member to the profit of another member. So that is on the tax group or the group relief slide that I would like to share with you. Now, as I mentioned earlier, there are certain election or certain tax position that you have to take in your first tax period, and this kind of position will not be able to be changed in the subsequent tax periods, right? And again, this position, this is what we said, the election. Now, one needs to differentiate between what we call it application and election. So before I go into each of these election, I'm just going to talk a bit about election and application. Now, in the application concept, it is a certain tax position as well. But then what happens is that you have to apply, and then to the FTA or Ministry of Finance, depending on the type of application that you have, and then you will need to wait for their approval before you actually can take that tax position. However, in the election concept, is that you at the time you file your tax return, or you're preparing your tax return, you can actually just choose whether or not you want to, let's say, take that tax position or not. Now, going back to the so-called irrevocable elections, basically this is the three most common elections that I've seen so far, and this is our irrevocable elections, right? The first one is so-called realization basis. Now, for most companies who have chosen to use IFRS as their, let's say, accounting standard, they will prepare the, let's say, the books on the accrual basis. Once it is prepared on the accruals basis, basically, then then certain unrealized gain or loss will then be factored into your profit and loss. Now, the UAE has said, look, you know what? The UAE corporate tax law has actually given you the option. If you think that your business model is basically not is not going to is going to be is not going to be able to benefit a lot from the corporate tax that relief that we have. They said, look, you know what? We will also give you the possibility to only tax your tax to only tax your profit on the realization basis. What does that mean? That means certain unrealized gain or loss will then be excluded once you calculate for your taxable income. However, you need to realize as well that prior to taking this decision, you need to be able to see what will happen in the future. Will you keep benefiting from that kind of election or not? Because it might be the case that it is useful for one tax period, and on the upcoming period, it will give you an adverse tax position. So this is important that you have a clear business plan prior to opting for this. The second one is what we call it the transitional relief. So for certain assets and liability, you have the option to adjust the opening balance in the first tax period to be in alignment with the market value. Right. Again, the certain condition have to be fulfilled for this certain type of asset and liabilities, and that's also something that you need to assess going forward. What you're going to do with this so-called elements, so that whatever you elect today is not going to have any adverse uh, tax position. Let's say the adverse tax position in the future. The third one is, of course, the intra-group transfer. So basically, what I'm trying to say here is that, I mean, it's not only for the first tax period, but it is in any tax period, but that you can elect that if there is any transfer within a certain group, now this is a different group, there is a condition for several related parties to be considered as a group. So you need to look at the condition. Now, if the condition has been fulfilled, then there is a possibility that if you transfer asset and liabilities from one group member to another group member, you can transfer it at the no gain and no loss position. Now, once you elect for that kind of position in that specific tax period, then for the upcoming tax period for the same type of transfer, you will have to adopt this kind of tax position. And this is something. And if it happens in the first tax period, then of course it is also can be considered as a irrevocable elections that you have. So that is about the, let's say, the short summary of the irrevocable elections that I want to share in this webinar today. So this will be the final slide. Similar to, let's say, the VAT deadline that we have in the UAE, in the corporate tax, the filing deadline is also equal to the payment deadline. Why I'm saying this is that because in other countries there might be other practice where basically the filing deadline is different than the payment deadline, but in the UAE these two deadlines are the same deadline. And also why I emphasize this is that because let's say if you're not aware of this, then we have seen certain cases where companies have filed the tax return and then they said, look, you know what, when should we pay for the tax? Considering certain practice in their jurisdiction, that the payment deadline is at the later stage after the filing deadline. So this is something that you need to take into consideration. And lastly, in terms of the penalties, now based on our experience so far, so supporting our clients with the corporate tax filing and payment, whenever there is a late penalties, this is already it's already automated within the tax authority or the Emirate tax portal that you have. So this is something that maybe you might want to take into consideration. I think the FTA has also encouraged a lot of businesses to file as early as possible, so that there is not really this type of last minute unintended late penalties. Because again, you also need to take, from a practical perspective, you also need to take into consideration the time needed to pay for the tax liability. Because if you are using, let's say, a bank transfer, then you also need to take into consideration how long it will take from the time you actually press the button or instruct your bank to pay until that tax payment hit the bank account of the tax authority. So basically, that's it. What I would like to share with all of you for the webinar today. If you, I think we
Thank you,
still have
Markus.
few minutes for some Q&A.
Yes, Markus. There are a few questions that have come to my private chat, so I've just put them into the chat here. I'll address them to you one by one, if that's okay. So there was
Yep.
one question which came that you mentioned something about taxation in the form of real estate. Does this mean if an individual non-resident has multiple properties in the UAE, it will be liable for that person, a natural person will be liable for corporate tax?
Um, if it's a natural person, most likely not. But we need to look at the nature of the properties and the transaction or income that you earn from the UAE. So it might be the case that you create a certain nexus and you might be subject to the UAE taxation. So I need to look at it from a case to case on a case to case basis here.
Okay. So an individual can also be taxed based on the number of properties they have. That's the case. Possibly taxed.
No, no. If a natural person is conducting business in the UAE, then they will be seen as business here in the UAE, and they might be subject to tax. That's what I'm saying. So
So
that's why we need to, usually how we support let's say, natural person clients, that we first need to assess whether there is the SS elements of doing business or business here, or the requirement to be licensed here in the UAE. So this is the first test, and only then we will assess whether they will be subject to corporate tax in the UAE, and if yes, then what will be the tax liability. So these steps we have to undergo in details.
All right, thanks for the clarity. The second question, Marcus, is how does small business relief come into the picture for branch offices who have majority operations outside of the UAE?
I do not really understand the question.
So if a small business relief, can it be applicable to can a small business relief, I believe that's the question, be applicable to somebody who has a branch office here and who has majority of their operations outside of the UAE? So whatever income they're making here in terms of revenue, I believe, would be sizable, but not as sizable as the overseas company whose branch it is.
Okay,
So
then let me first
yeah.
go back to my earlier slides. First of all, this branch office in the UAE, and I presume this is the branch office of a foreign entity. We need to assess whether there is permanent establishment or not in the UAE, right? And then we need to look at, once you have a permanent establishment, then you need to look at as well. For the next one is that what would be the income and expenses. So I would say, so revenue and expenses, so the taxable income that would be attributable to the UAE. Now, in terms of, and then you will be able to determine what sort of tax liability that you have in the UAE. Now, this is something that currently I think I will take it separately, because in my slide I did not mention anything about the small business relief. But this is something that one needs to look at further into the what do you call it, the corporate tax law, whether there is a permanent establishment, and we need to assess whether that permanent establishment is basically eligible for small business relief. So the question here is, I think, more not on the fact that the type of the entity is branch office, but we need to look at that specific permanent establishment.
Okay. Thanks, Marcus. So small business relief is another chapter that is not covered in this one. So anything that you'd want the SMEs and the micro businesses to remember or remind themselves of while they are filing for corporate tax? Any few points that you'd like to just highlight as
Well,
hygiene?
again, I mean, if you're looking at this at applying the small business relief, then please make sure that you first of all, that you have fulfilled all of the conditions that is mentioned in the law. One, two, that it will not give you tax adverse impact in the future. Because electing for small business relief does not always mean that it is beneficial for, let's say businesses that have revenue less than 3 million dirham, right? So this is the cost benefit
Yeah,
analysis still has to be done.
sure. So in a way, if there is a potential of paying tax now and not opting for small business relief, might as well take it and then in the future uh, work around it or work with it. That's what.
Yeah.
Yeah. Okay.
Yes,
Thank you.
I give,
Yeah.
or I give you an example, right? I mean, because the next question is about tax losses. So it's like, I mean, one of the examples that you need to take into consideration is that, do you want to carry forward your tax losses or not to the next period, right? Because I think if you apply for small business relief, tax losses will not be able to be utilized to a certain extent in the upcoming tax period.
Right. Yeah. I think that is connected. And the next question was, how can one record tax losses?
Yeah. So again, tax losses, or well, I would say tax liability or not liability here. It's the calculation of such, that's a tax liability. It would start from your accounting, and it is written as well that most company will have to adopt IFRS. If you're smaller business, you can adopt IFRS for small business, or you can adopt, let's say, the cash accounting. So that where you need to decide how you are going to first record your books in order. So I mean, again, perhaps I have not mentioned in my slide that what one needs to do now is really to make sure that their accounting, let's say, that bookkeeping is in order, because starting point of calculating the tax liability or taxable income would be from that bookkeeping. Now,
Yes. Most
once you
important is that. Yes, I agree.
yes, so once you have recorded this according to whatever standard that the FTA allows you or oblige you to do, then you will arrive at what we call it profit before tax PPIT. And from then on, then you need to go back to the corporate tax law and see what expenses can be deducted and what expenses cannot be deducted, what income is exempt, what income is taxable, right? So that is more or less in a nutshell how to calculate the tax liability. Now, if after this calculation you arrive at so-called the tax losses, which means that whatever losses that you have in your books is similar or equal to whatever tax losses that you have, then what happens is that you can make this adjustment when you actually are filing for the tax return, because over there you will be able, in some of the boxes you will be able to make that adjustment in those fields, and then it will then give you the amount of tax losses or tax liability, taxable income that you have. So I think that is where you can see where the tax losses are.
Yep.
Now, if the
Sure.
condition are fulfilled, of course, these tax losses can be utilized at a later stage.
Great. Marcus, one question comes to my mind, and I'm conscious of time, but there are two more, so I'll ask you one from my side. There is a lot of hearsay, or there is a lot of activities happening where the small, very micro VAT and tax consultants and people who are just, who want to take quick money and easy money from SMEs and micro businesses, they are all trying to put and push in the small business relief applications because they don't want to probably do the due diligence or record the filing properly in the right way. And they're just trying to do it because there's a deadline, and even the entrepreneurs don't really understand the importance of whether they should be filing SME relief or not. What are the dangers that they might foresee in the next year or so if they're doing small business relief where they should have actually not done that and just filed, yeah, pure play tax?
One of the, let's say, economic disadvantage that I said earlier is about the carry losses of the carry forward of the tax losses.
Yeah.
However, prior to any, again, the FTA has been very helpful in terms of giving guidelines to businesses to calculate the taxable income in a lot of conditions that they have, and also to submit the tax return. So I do, and I think there is a special guidelines for small business relief, if I'm not mistaken. So I do encourage, so whoever is in this webinar, or businesses in general in the UAE, please go to the FTA website and have a look at that guidelines. It has been written very well in a way that it is I would say, as a tax practitioner, it has been written for, let's say, common people or laymen. And some of the languages they are, I would say, is quite a layman friendly one, right? And also the FTA has conducted so many sessions on how to basically calculate your taxable income, as well as on how to file your return. And they have also put in the FTA website the webinars, sorry, the recording of those webinars or those sessions. So I do encourage businesses, or let's say smaller businesses, who would like to have a second opinion, to just have a look at this website in the let's say website of the FTA, of our tax authority. That's tax.gov.ae, and you will find a lot of material, and this will help you also to do your cost benefit analysis when you have to take a certain tax position. Going back to my earlier presentation, is the certain election that you want to have, and small business relief is one of it. So that would be my message to all of these attendees of this webinar.
Thank you. Thank you very much for this, Marcus. This is an important piece for us SMEs, at least in the context of this network. Just last two questions. What about foreign expenses paid online and invoiced outside? So subscriptions that are outside of the UAE. I think this is relevant to me as well, because we've got a lot of SaaS models subscribed, and they're invoiced outside the UAE. We pay in through the credit card or the debit cards, where we are taxed outside. Can we showcase it as taxable cost in our records for the UAE?
Okay, but again, I would like to clarify this first, because if you mentioned the word tax outside, what do you mean by tax outside? I mean, I do not know that, so I cannot cover this in detail. However, if what you mean is that whether the expenses that have been incurred for the business in the UAE is that comes from a supplier that is a non-resident in the UAE, so overseas supplier, whether that expenses are deductible expenses from the corporate tax perspective, the answer is yes, as long as these expenses are for the business that you're conducting here in the UAE.
Yes. So if I were to give you an example, let's say there's a subscription that someone has taken for CRM marketing or something like that, and it's built outside the UAE because that subscription does not have a UAE entity. But there is a tax element for the place where the entity is registered. It's still liable. We can still show it as a cost and have that tax element placed there.
I believe the tax that you're referring to is the VAT of GST of that country that finally they are taxing here, or is it the VAT of the
Yes,
UAE?
it's the
Which
VAT and
one?
GST of that country.
Okay, then basically the way I look at it here is, I mean, in general cases, it will be the it will it's and sorry, if the whole taxation, including the services that you buy, is necessary for you to conduct your business here in the UAE, then it should be a taxable, or it should be a deductible expenses.
Deductible, yes. All right. Thank you so much. Thanks for the clarity.
Sorry,
Last
but
question, Marcus. Yeah.
yeah, sorry, just one last sentence. I have mentioned earlier about this concept of residency. So basically, what I'm trying to say here is that once you're a tax resident in the UAE, you are also taxed on your worldwide income, which means as well, if there is any certain expense elements for you to generate those income, you might want to consider to include it as your deductible expenses. But of course, you need to have sufficient evidence and documentation to prove that yes, these expenses is indeed for your business or the taxable income that you have, or income that is subject to tax that you are, let's say, that you are earning as a tax resident here in the UAE.
Sure. Thanks for the clarity. Last question, Marcus. In case the related party schedule is required to be filed along with the corporate tax return based on the applicable threshold, how should the expenditure be reported? The guide mentions, I assume this is the FTA guide, it mentions that both income and expenditure need to be shown separately. If you can kindly clarify whether the expenditure should be disclosed as a positive figure denoting the expense or a negative in the minus form.
Well, I think I would refrain to answer this question now. It's because it's very specific on how to file the corporate tax return. And whoever is mentioned this, if it is part of your network, perhaps we can have a separate session on that topic. However, what in general, when it comes to related party transactions, or as a transaction with related party and connected persons, you need to look at it, what is actually the nature of the transaction, whether the nature is actually you are providing or selling goods to the recipient, or you are receiving service or goods from, let's say, the service provider. You are a recipient or service provider, right? Or basically seller. So this is something that you need to look at.
Yes.
Now, if two transactions are separate transactions, then basically you have to disclose it separately, because again, purchasing a transaction is one transaction, whether it's goods or service. Sales transaction is another transaction, whether it's goods or services.
Yes. I think that would be the most logical as well, as you described. Oh, that brings us to the end of our questions, Marcus. I think this was very useful. For everyone who had to jump in and jump off, we're aware that you'd like to watch this at your leisure. We will give you an edited version as a link soon after the webinar. And yes, Marcus, thank you once again. Thank you so much for doing this.
Thank you
This
very
will be
much.
very, very helpful for everyone. Thank you,
Thank
everyone,
you.
for joining. Have a good day. Bye-bye.